Hi, I'm Mike Richter, and today we're going to be talking about home loans. Should I get a 30-year or a 15-year loan? The reason why we're talking about 30 and 15 years is because those are the two most common amortization schedules or payoff schedules that you have for home loans. Let's get into the overview. First, we'll talk about mortgage loans and what they are and kind of a little bit of some background on how they came to be. We'll talk about what the key differences are between a 15-year and a 30-year mortgage. And finally, we'll talk about under what circumstances might I want each kind of loan, because every loan is going to be different for everybody. Right? You might be better off getting a 15-year or a 30-year depending on your circumstances. So we'll talk a little bit about that. So what is a mortgage? A mortgage is a term. The word mortgage comes from a French legal phrase meaning death pledge. Let that sink in for a while. If we're talking about 30 years of your life to pay off this loan, it might seem like you might be dead by the time you actually pay off the loan. But really the death part of death pledge for mortgage means that the agreement dies when either it's paid in full or if you end up defaulting and end up having to have the house foreclosed on. And all a mortgage is a fancy name for a loan for a house. And how it works is the loan, the money is lent to you for the purposes of purchasing the house. And the house is collateral. That's the thing that has value that the loan is using to secure itself. That way, if you don't pay the loan, they take the house, which was the security used to get the mortgage in the first place. So let's talk about some key differences between the two most common kinds of payoff schedules, the 30-year and the 15-year mortgage. A 30-year loan is by far the most common kind of loan that's out there right now. And that's what everybody assumes you're going to use when you're purchasing or when you're on the selling side of a house. And the reason why is it affords the lowest payments and the most buying power for buyers. This is a double-edged sword because it's also really good for banks because you're paying interest a lot longer and you're paying more interest up front. And they're banking on the fact that you're not going to have the mortgage for 30 years. So if you only have it for 7 years, you're paying mostly interest for that first 7 years. And if you end up selling the house or refinancing the mortgage, well, guess what? If you end up refinancing back into another 30-year mortgage or you buy another house with another 30-year mortgage, your first 7 years is still going to be ridiculously slanted towards interest. And we'll see some of the reasoning behind that and some of the results of what come from that in a couple of examples later. But the thing about 30-year loans is they're really good for banks because they get to collect more interest on you, and they're really good for realtors because they get to use the fact that you could use a 30-year loan to be able to qualify and be approved for a higher purchase amount, which means that they're likely to want to sell you things that are on higher purchase amounts because they get a higher commission on that. Now, this isn't going to be the case for every realtor, but there is a big slant in that thinking right there. So you want to make sure that when you're dealing with a realtor or someone that is going to be representing you, that you let them know what your objectives are, what your budget is. Even if you are qualified and approved for more, let them know what you're looking to spend and make sure that you're firm, and that'll do a lot of good toward making sure that you get directed to housing in your budget area so you don't overspend, even though you're qualified or approved for much more than you're budgeting for. Now, 15-year loans, by contrast, are designed to be paid off in 15 years. So the payments are going to be a little bit higher, and the reason why is because you're paying more principal, paying the loan down faster. So this is really good for people in stable financial situations and people who want to pay off their loans faster. And this is primarily for people that want to stay in a house or stay in a given area. We'll talk about more advantages to a 15-year loan in a little bit. So let's look at one example circumstance and then compare how a 30-year and a 15-year loan kind of compare side to side. So for our circumstance, we're going to assume that we will have a $100,000 loan. And we will also assume that today's rate on a 30-year fixed rate mortgage will be 4.5%, and the interest rate on a 15-year mortgage is going to be 3.5%. Now you'll notice that a 15-year mortgage, the interest rate on it is going to be significantly lower than that of a 30-year mortgage. To the bank, there's a lot less risk involved, and they're getting their money paid back quicker. And typically speaking, 15-year mortgages have a much lower rate of foreclosure and a much lower rate of default than a 30-year mortgage. So it's really advantageous to the banks and those that are lending money on 15-year terms to do that. And by contrast, a 30-year loan is by definition more risky. There's a higher chance that you won't be paying your bills. You may be overextending because you're buying at the top of your pre-qualification, top of your pre-approval price range. So there are a lot of factors that go into that. Now let's break down the numbers a little bit. So on a 30-year fixed rate mortgage of $100,000 at 4.5% interest, you can expect your payments of principal and interest to be $507 per month. Okay, pretty good. The total cost over 30 years, if you pay exactly $507 every single month and not a dollar or a penny more, the total cost to borrow that $100,000 is going to be $182,400. So the amount of interest you're paying over the life of the loan is $82,400. So keep that number, $82,000, in the back of your mind when we start talking about the 15-year option. Now, for a 15-year loan of $100,000 at 3.5%, your monthly payment is going to be a little over $200 more per month. It's going to be $715 a month, principal and interest. Now, the total cost of that loan over 15 years, paying exactly minimum payments, will be $128,700. So we're thinking back to the 30-year mortgage, and the interest that we paid along those 30 years is $82,400. For the 15-year option, we paid $28,700 in interest. So the difference, that $208 more a month that you pay on principal and interest, saves you $53,700 of interest across the life of purchasing that house. That is a huge difference. And the reason why is in a 30-year mortgage situation, you're getting hit super hard on interest at the front of your mortgage for much longer than you are on a 15-year loan. Plus, you're paying your loan down slower, so you have more of a chance for the bank to get more and more interest. So this goes to show why a bank would really like to loan 30-year mortgages, because they get so much money out of it. Note, if you were to pay $715 a month on the 30-year loan, so say your minimum payment is $507, but you decide to pay $715 anyway, you end up saving $40,300 in interest. So you don't save the full $53,700 in interest because you're still paying a higher interest rate on a 30-year loan. But the cool thing about using a 30-year loan and then paying extra on it is that you have the flexibility where some months your budget might be tight. Maybe something comes up, you need to go to the dentist one more time, you have to deal with getting a crown or something like that, and maybe that $200 will break your budget for that month. You can see the advantage of having the lower payment option available to you. You can always pay more, but you can't pay less. Otherwise, you're going to be in trouble with the bank or whoever is servicing the mortgage. So you can see there's a lot of power in the 15-year loan if you're looking to pay off the house and pay minimum payments. Whereas if you're willing to pay as if you're paying on a 15-year loan, you can still reap a lot of that interest savings even if you have a 30-year mortgage. You just have to pay a little bit more for the flexibility of having those lower payments if you need to. So why might you pick either of them? Well, a 30-year loan is really good for cash flow. I use 30-year mortgages primarily on all of my investment real estate, unless for whatever reason a 20-year loan, right? That's not something that I talked about, but a couple of my properties have 20-year loans because the cost of a 20-year loan was the same as a 30-year loan in the situation that I was in and given the interest rates at that time. So it made a lot of sense for me to take 10 years off of the life of my loan and pay the same amount. Seems like a no-brainer there. But I use 30-year loans for the most part for cash flow because I don't have to worry about having to pay that extra $200 a month in the example scenario, and I have the flexibility that if I want to choose to take the rent or the excess rent from a few houses and then pay down one house in particular, I have the flexibility to do that. Now, the reason why you might be a little bit leery about using a 30-year loan is that a 30-year loan might cause you to overbuy if you're not careful, because the amount that you can be pre-qualified and pre-approved for on a 30-year loan is much higher than it would be on a 15-year loan. It could give you that inflated sense of how much you can afford to buy, and you might overbuy and get yourself into a financial struggle. So that's one of the dark sides of the 30-year mortgage, as well as the fact that you're paying more interest for a longer period of time. But if you're only going to own the house for a short period of time and you're expecting the house to appreciate rapidly, then maybe you're going to get a 30-year loan anyway, just because you're not looking to live in that house forever, and you're looking to just own a place, build equity, and hopefully the appreciation makes it worthwhile to you. Now, the 15-year mortgage, I have a couple of friends of mine that they're at a completely different stage in life. They're about 30 years older than me, and what they do with their investment real estate is they buy it and they put them on 15-year loans, and they don't expect any cash flow from their real estate. And the reason why is they're close to retirement age, and they want to make sure that their houses are paid off in full, and they plan on just using those houses as their workhorses and to generate passive income into their retirement. And that makes sense for their circumstances. Whereas in my circumstance, I'm 30 years their junior. I'm still looking to build a real estate empire. So the flexibility and the lower payments and higher cash flow makes it more advantageous for me to use 30-year mortgages. Now, I'm going to give you a little bonus rule of thumb if you're looking to be really conservative in the way that you purchase real estate for yourself for you to live in, and you're planning on using a 15-year loan. A good way not to overbuy would be to set your max purchase price to whatever you can afford on a 15-year mortgage where your principal, interest, taxes, and insurance do not exceed 25% of your gross income. So what that means is if you're making $4,000 a month gross before taxes, before anything else, and your full mortgage payment, principal, interest, taxes, and insurance on a 15-year mortgage is $1,000 or less, then you can afford to buy that house very comfortably and not put yourself in a financial strain or financial struggle. So that's a good rule of thumb that I would use if instead of looking to build a real estate empire, I was looking just to buy a house for myself and pay it off quickly so that I could take advantage of the money that I was using to pay the mortgage and to do other investments with it. So just as a quick recap, we talked about the basic idea of a mortgage loan and how originally there was a French legal expression for mortgage, which means a death pact, or rather a death pledge. And basically the idea was it dies either when you pay it off after 30 years or 15 years, or when you get foreclosed on. Now, hopefully you've been educated to the point where you're not going to face any foreclosures because you're going to use a good rule of thumb of only using a quarter of your income to purchase property for you to live in. That way you're using less of your disposable income to deal with housing, and it'll help you out in the long run. We also talked about how a mortgage is simply a loan that uses the house as collateral for the loan. And we talked about some differences between a 30-year and a 15-year. Basically, all the year amounts is how long it'll take for you to pay it off. For a 30-year loan, you have lower payments, but you're paying more interest over the life of the loan by a lot. And we also talked about how a 15-year loan, you're paying it off faster, but you have larger payments to deal with. But one of the cool advantages of a 15-year loan is you typically have a much lower interest rate on a 15-year loan than you would on a 30-year loan. We also went through a quick example loan, and we took a look at what it would look like for a 30-year loan and what it would look like as a 15-year loan, and we explored the benefit of getting a 30-year loan and paying on it as if it were a 15-year loan, so that you have the advantage of lower minimum payments, but if you have the available cash flow to pay down on it, by all means you can pay down on your loan. And we talked about some advantages to either or. The 30-year loan is really good for cash flowing real estate, but you have to be very careful with the 30-year loan because it might cause you to overbuy. And finally, we also talked about a 15-year loan can be really good for rental property that you intend to hold and use as your income generator for your retirement. And you don't need the cash flow now, but you want to accelerate the rate at which you pay off your mortgage later. So if you felt that this content was valuable at all, by all means, go ahead and give it a like. I'd really appreciate that. If you know anybody that can benefit from this, they're looking at buying a house and they just don't know what kind of loan they should be looking to get, by all means, go ahead and share it. Hopefully they can learn and use the information to their advantage. If you want to hear more from this channel, then by all means, go ahead and hit the subscribe button for more videos. And also, down in the description below, I'll have a link to a PDF for free that outlines 60 of my top rated books to read. I've got real estate as one part of it, personal finance as a part of it. I've got relationships and leadership, sales and management. There are several kinds of books down there. So if you're looking for something good to expand and broaden your horizons, then by all means, go ahead and check out the PDF. They're very easy, clickable links so that you can buy the books on Amazon. So this is about the time in the video where I say thank you so much for your time. I know that you have lots of choices of what and who you can watch. I hope you have a fantastic day.